Hello, my name is Tristan. I will be discussing how hedge firms conduct quantitative equity investments. Through backtesting an equity industry momentum strategy, I will examine the feasibility of evaluating industry performance based on average returns, volatility, and risk-adjusted returns. This analysis will examine industry trends to determine if winning and losing momentum is constant or predictable enough to make profitable investment decisions. As you can visualize here, the ranks of industries with the given data are quite volatile over the last century and is clearly visible with the automotive industry plot. Its shifting rank from best to worst performer over the period indicates constant changing economic conditions, which enables high competition for all industries. This can be seen in the plot of the average rank of all industries, which sits around the middle of the data set, creating a small range of about 3 ranks on average. The winner portfolio investment strategy consists of buying into the top 15 performing industries for a given period, typically for no more than a year. Risk is mitigated by diversifying across N industries. The Sharpe ratio is high as it only focuses on top performers, but still only captures most of the positive market movement. The loser portfolio investment strategy consists of selling the bottom 15 performing industries. Alpha is relatively too small to be a good investment. The Sharpe ratio is noticeably lower than the winning portfolio and the market. The long-short industry momentum portfolio investment strategy combines the winner and loser portfolio strategies, yielding a beta close to 0. A very high Sharpe ratio indicates a good return on investment for the capital exposure, but alpha is less than the winner portfolio. Regression against excess market return indicated alpha is significant at the 99% confidence level and beta is significant at the 95% confidence level. Utilizing the industry momentum portfolio, but for a smaller number of firms, concentrates the returns on the more extremes of the industry performers. This should be represented by higher kurtosis as the diversification of the portfolio has been reduced and the probability to generate larger returns has increased. While an original number of firms at 15 for both the winner and loser portfolios was used in previous analysis, it may be more rewarding to consider a range of 8 to 10 industries per portfolio to remove the extremely volatile middle industry performers, which are hard to predict the momentum of. Without choosing to make N too small, an investor may be able to increase excess returns without impacting their safety and diversification too drastically. The plot of the log cumulative returns of each of the portfolios shows the winning portfolio is much more consistently able to outperform the market and would therefore be a strong strategy for investment. The loser portfolio clearly generates the least returns and should not be considered for investment. It is riskier than the other portfolios and clearly underperforms in comparison. The market and industry momentum portfolios are closely related in their returns. Due to shorting underperformance, industry momentum can capture returns outside of the market portfolio. During March to May 2009, industry momentum portfolio was at odds with market returns due to widespread recovery and growth across all industries. The portfolio suffered as the lower-ranked industries outperformed current market leaders. The exposure in hedge fund short positions, therefore, was greater than the growth in the top industry performers at the time and indicates a reversal in industry leader performance. Due to the interconnectivity of the world, globalization shows how events in major markets such as the US and China can have flow-on effects around the world. Performance reversal likely resulted from quantitative easing policies by governments to boost liquidity and avoid the prospect of a long-term recession after the GFC. The US government introduced several policies to stop the decline, including bailing out banks and automotive industries with the introduction of statutory aid through the American Recovery and Reinvestment Act of 2009, which included stimulus packaging and relief. It is important to note significant economic events such as the Asian financial crisis, dot-com bubble, and the GFC heavily contribute to the outcomes of these investments due to the rapid change in liquidity and momentum as new capital and market sentiment shift suddenly. This can make it difficult for hedge fund managers to successfully navigate evolving market conditions and expectations. Analysis of portfolio strategies indicates taking a long position in top industry performers is a sound strategy in the short term to capitalize on year-to-year competitive fluctuations under effective and active management. Shorting the worst performing industries is not a recommended strategy due to high risk and low reward. Holding a long short portfolio is less risky than holding only a winning portfolio, but is almost indifferent to holding a market portfolio. Thank you.